Hi everyone, and welcome to a brand new episode of Market Watch. Today we are looking at what's going on in the UK and the Eurozone in general. We drop a new video of Market Watch every weekend, but on Monday, Wednesdays and Fridays we upload videos where we analyze stocks. So make sure to subscribe and put that notification bell on so you don't miss any episode. Okay, thank you. So the British Prime Minister Liz Truss and her Chancellor Kwasi Kwarteng haven't had it easy recently, as the Bank of England had to step in to halt the potential market crisis during a time of high inflation and increasing interest rates. Economies worldwide are trying to dampen demand and the economic activities to combat inflation. UK then decided that they are going to push for a tax cut during a time of uncertainty. The result of this action sent the pound on strong downward swing and the 50-year government bond yield from a 0.5% up to 4.5% before the Bank of England had to step in to buy bonds in order to halt the potential crisis. The move also had an impact on the US dollar as it gained momentum, and it also affected the stock market and commodity prices negative. The reason to why I believe that tax cut is a bad move right now is because as they borrow more to support the tax cut, UK will have to take on higher borrowing costs due to higher interest rates, and the tax cut can create larger inflationary pressure to the economy, and the UK has already a lot of debt if we look at the debt to the GDP and also the current account deficit. Inflation is not transitory as the Fed once believed it to be, and there is no easy way out of this mess without some pain, and adding more inflationary pressure is not the right way to go, because as they borrow more, the lower the currency must go, or the higher the interest rates must go. So we got some data from the German IFO climate index, which rates the current business climate in Germany and measures the expectations for the next 6 months. The data have gone from a 98.9% September 2021 to now coming at 84.3, which is a significant decline, which I believe will send a ripple effect across Europe and have an impact on the overall economic sentiment. We also got a statement from Christine Lagarde, who is president of the European Central Bank, who spoke at the hearing of the Committee on Economic and Monetary Affairs of the European Parliament. She basically said that the economic outlook for the euro is darkening because of the war in Ukraine and the inflation, which they anticipate will stay above their target for an extended period. The economic expansion in the euro area was made possible because of the strong labor market, consumer spending, and the economies with large tourism benefited because of easing of COVID restrictions. And the ECB expects slow growth in the coming quarters because of high inflation is dampening spending and production throughout the Eurozone, and this is also reinforced by the gas supply disruptions. The strong demand for services that came in with the reopening of the economy is losing steam, and the weakening global economy due to tighter monetary policy. Uncertainty remains high, as reflected in falling household and business confidence. The ECB believes that the ECB believes that these are the factors that are the reason to the downward revision of the economic growth. They expect the economy to grow by 3.1% in 2022, 0.9% in 2023, and 1.9% in 2024. Inflation rose to 9.1% in August. Energy and food price inflation remained extremely elevated and are the dominant contributor to the overall inflation, and is spreading across more sectors, which is part due to impact of high energy costs across the whole economy. And because of the overhanging risk and pressures, the ECB have decided to raise the ECB interest rates by 75 basis points. And they are also anticipating raising interest rates further as time goes on to dampen demand and the risk of higher inflation. For me, this is another indicator that we are going to see the economic growth decline, and have central banks increase interest rates will have a negative impact on the stock market, especially growth stocks. And I believe that most investors are either pulling out or buying dividend stocks. I will continue to be monitoring the economic development and also view this as a major opportunity, and will be buying stock as time goes on. So what's your take on everything that is going on right now? Are you buying, selling? I would love to hear your thoughts. Guys, That's all I have for this episode. I hope you have enjoyed this one and will continue to watch. A new episode will be out next weekend, but we will continue to upload new stock analysis every Monday, Wednesdays, and Fridays. If you haven't done it already, please make sure to like this video, comment, and subscribe, and let's reach 300 subscribers. I believe we can do it. Thank you guys so much for watching. Please take care of yourself, and I hope to see you on the next one. Take care. Bye-bye.